All right. Greetings, market rebels. Welcome to this week's sector situation. It's Sunday, April 30th, 2023. It's a little in front of 2 p.m., I think, here on the East Coast. And we need to take care of a few slides and then we can get into it. And this will be mercifully short this week. I'm recording this much later than I typically do because I had some family obligations, and it seems like there's confusion when the videos are not completed. And please have a look at our intellectual property rights notice after checking out our disclaimer. When the videos are not completed, it seems like it causes a kerfluffle, I think they call it. So we're just going to get this done more quickly. And honestly, it's not even really worth going into a lot more time at this point again, which is unfortunate. We need to get back to that. We need to get back to get this bear market potentially over if we're still in one. Get back to a bull market, and then this will really be much more helpful. But plan program, this is really from macro measure. So if you want to check out what the focus was in macro measure, there's plenty of other reminders from other weeks that we've discussed. But the whole point of me just flashing these is if you want to stop on them or something, you can, and just maybe take a snapshot of what we talked about to remind yourself. But what we've been trying to do, and let me just stop the share on this and then reposition. What we've been trying to do is just stick and move with the market. So that's what we do every week. And this program really flows the same way. Why won't this shut down? There it goes. So you'll see like how we went from one thing to another and this and that, and what our focus has been if you're new to all this stuff, and why we do what we do, which again, just one way to do it. Let's get the share going again on our main screen, and then we can start talking about the sectors. Now, this was interesting because this was all going risk off. I put a little note in, things were looking pretty rough for virtually every sector. Not every single one, okay, but virtually every sector was starting to look pretty bad early in the week. But as all of us know, and as we can see, what did the gang do by the end of the week, right? They turned virtually everything around. We went from risk off to risk right back on again, and maybe then some. So most things have room to run in terms of RSI. Most things. The only things that are really up there are staples, XLP. Technology's up there. It's at 60 on the daily. That's not crazy high, but of course it's got room to run to break out if it wants to, which I would say is probably the most likely scenario soon because of the higher lows they put in. And then XLC, of course, also checking in with a 63. So Meta and Microsoft, that maniacal move that those put together, clearly, right, influencing these sectors a lot. And look at this incredible turnaround in transports after those were breaking down on Tuesday and Wednesday, right back to where they were virtually on Monday. Just an amazing. But remember what this all goes back to. And again, if you're new and you haven't heard it enough, just in hopes of helping out the cause, right? Let's go back to take a look at SPY. And I'm going to magnify this a little bit more because I know this is a simple screen that I've got because I try to have a lot of information so I can act quickly on things when I'm writing up new ideas. And that's why there's so much garbage on all my stuff. But this is honestly one of the more simple ones. You just don't know what factor bit of data you need to look at in any particular situation. So I have some templates for virtually all of them. But this is what we should talk about. This is what I want to remind people. If you don't watch macro measure, I covered it, but I won't belabor it. But look, we had this little rectangle there, and I'm just going to kind of extend it. We went into this rectangle, and that should be good there for now. And if you notice what they did, right, they barely exceeded the prior low there that was set on 331, the end of the quarter. And this is what they do, right? They barely exceed things. And that's when you do see a lot of sort of sharp, sudden reversals. So if you're a breakdown trader there, you've just got to get it ingrained, in my opinion. This could be a legitimate breakdown. This could be a false breakdown. One or the other, handle it accordingly, right? So knowing that both are possibilities. These guys are great at doing this. They do this kind of thing all the time, where something gets, again, barely exceeded and then strongly reversed. And it might even be complete malarkey, like the ridiculousness we saw this week, where thousands of stocks were dropping, 2 stocks were rising, and yet this is what they were able to do with the S&P 500. It's the theater of the absurd, but it is what it is, and that's where we are, and that's what we need to trade in. So we don't have a choice but to do the best we can within the pain amplifier that it can be at times. But that is the just kind of quick tutorial on, hey, just get that ingrained. Breakouts and breakdowns are both possible, but so are false versions. So until you're really clear and seeing signs that things are really, really, really trending your way, you just got to be ready to take action in terms of your position management. But getting back to all the sectors, I don't think you can be thrilled in terms of, oh, this all looks like it's going to go. I think this all looks like it has the potential to go, right? So higher low versus these lows, that's stark. Strong run up there in energy, pullback. Now it looks like it wants to go. Okay. Same thing almost across the board in many of them. This one here, real estate had a consolidation, but they've got that ready to break out. Another thing that for me makes very little sense, but again, we can't trade on what makes sense. But you have to be ready that this could be a legitimate breakout and it could keep going, or this could be a false breakout. We'll see. But they've got things in areas across the board for the most part where they're not too far away from taking out a potential high. And remember, they've got FOMC, they've got Apple, and you can see how just a few stocks marked up insanely can really force the major market index ETFs to go along for them with the ride. And then once players and algos sense, of course, that there's squeezing to be had, then it fans out and intensifies at times, right? So with all these RSI readings kind of being middling, except for maybe Staples and the other two we mentioned, there's room to run, right? So that's what I would be prepared for. I think I would not fight against it, even if I doubt the legitimacy of it, even if I see that the breadth in a lot of these things is very poor, just like in the major index ETFs. It doesn't matter. They can still play their games and have things continue. So I think you've got to be ready for that. We did say for most of April in the newsletters in Macro Measure that we were not really willing to lean strongly. And I think that really, again, it was a tough month. And even this week was a tough week where you had a breakdown and then a reversal. So not having this really strong lean probably was the right thing. And this is what I think frustrates people that want to see some commitment all the time. And sometimes it's just not there. And it's sort of like, right, I played a lot of baseball when I was a kid, and sometimes you have an idea where maybe the gap in right center is very wide. You want to try to send a line drive out there. But if they pitch you inside consistently, it's pretty hard for you as a righty, that is, to be able to send that ball with authority, right, out towards center field and catch a gap, maybe get a double, maybe more, clear the bases, regardless. But so you can only do what you can do within what's available, right? And that's what we always have to go back to. So it was a tough month. We had, I think, a great start to the year in our services. I would say these were people still handled things well, but I got to give them a lot of credit for that. But it was not easy at all. It was kind of tough, honestly, I think, very tough. But maybe we're going to see this strong leg up, corrective action. Maybe we'll see a breakout, another leg up. I talked about that in Macro Measure, so I don't want to belabor it here. But what we will do is look at some other things to see how maybe they've shifted as well. So one thing we've been looking at, of course, is crude. And come on. So let's take another look at crude. And this did come back, close this gap. So I had a couple bearish ideas on thinking that maybe this could happen. They closed the gap this week, and now they instantly held it right near there. They're trying to reverse it. So this has been cagey. This has been tough to trade this space for a while. You can sort of see that it's just not been a lot of sustained movement at times. But they've got this going. They're close to trying to break it out. I think what I keep an eye on there, if they do try to move this up, is wait for them to see what they can get back above the 20. They can get back above the 20 and SMA and light blue there and get going even more. That could really be the start of something, because it probably attacks 200 from there. And then if they take that high out, it's going to look like a strong leg up, a solid corrective wave lower, then maybe embarking on another leg up. But I think that's a mixed bag still, because you're really still immersed within a lot of this kind of noisier price action. So I still don't think that's easy. That won't be easy unless we take out, well, let's do this, take out these lows, then you'd start looking for maybe retest of those. Or if you take out these highs and you're not overbought, then it would start getting a lot more interesting. But still have to trade smart, really smart, disciplined in there. Lumber, we were talking about how the real estate housing's been incredibly resilient, kind of mind-boggling if you ask me. But again, I traded through 2007, and I recall how they were able to really make things still hold up despite all the carnage that was on our way. And in fact, I think a new high got put in somewhere in November of that year, even after, for us at least, it was very obvious that there was trouble on the way. Speaking of trouble on the way, lumber, just even in the frenzy, right, of last week that saw XHB and other real estate ETF related or home building ETFs kind of buck the economic trend and still find a way to either be neutral or go higher. Lumber's not flashing anything special right now, so I'm not so sure that's a great situation, a great development there. Let's take a look at copper. We do the best we can with what Thinkorswim offers us here. And that too, right, that's sort of like piddling. What are you really going to say about that? Okay, it dropped. It's not a big mover, but it's not as if, right, it's currently breaking out and like defying the economic take that a lot of us have. That we could sum up by calling concerning, a concerned or concerning take. So that's not lighting the world on fire either. We do see also that SMH, another big important sector, that has that they've been able to do what they've been able to do with the market really without SMH doing much, because SMH really went haywire to the upside and then at the end of the first quarter, and then it's backed off. But notice it's still holding longer term trend. It just left this rising channel, right? So now it needs to fight its way back in there. That could help this market. And so if it helps this market out, then that would really, of course, be a big boon for the market. So keep an eye on the 20-day there, and SMH would be my quick take on that one. I do think the technicals probably favor bulls overall still, but it needs to do some work to kind of shift that balance a little more towards the bull side. I think it's definitely in flux, right? You could see that where if the 100 in the white dash line, if this were to get taken out, that would bring about more weakness, and you really would you'd have even more of a breakdown out of that channel. So not a good development. Could mean that we get even more corrective activity. So an important sector to keep an eye on, though. What I meant in real estate was something like IYR, where this is suddenly, right, this is looking a little more bullish, and it may just very well go. I've got some bearish positions on in IYR and other things, but they're very low risk for now. And my plan is to manage them in a way that if they really jam these things, I'm going to buy back my short options at a really low price point and then wait it out, because they're very long term for what I typically do. They're out towards next year, 2024. But that was one that, of course, did a little bit better. XHB, right? This is really bucking again, like I said, the economic trend, practically back at the highs. So I think that's on borrowed time. I kind of felt that way in 2007. I was right. Ryan was right. Ron, our former departed, unfortunately, friend, colleague, he was right. We were big on what was happening back then. But remember, right, a lot can happen between when reality finally kicks down the door, kicks down the facade that the market has created, and you could have a lot more upside. And again, we could also be wrong, right? So I'm not fighting against any of these things. I'm just trying to be smart about what I do. XAU, we typically take a look at this one. This one, you would have to say, look, this is trying to curl up a little bit. It's got the down sloping SMAs now. It needs to fight through there. Otherwise, right, if you see another failure there, you probably want to see if it then is going to come in here towards the 150 in white and gold, respectively. And Thinkorswim just hatchet jobbing me on the price axis for some reason. Does that to me. But to keep an eye on that, I am bought more now that it pulled back a little bit, but that's really just out of discipline and the hope to be wrong, literally hope to be wrong about needing to own that and other, well, things related to it. Let's put it that way. I don't own that particularly. XBI, something we look at from time to time. We did catch a little mention of this a few weeks back before it had its moment in the sun. Right, potential higher low put in there, has to fight its way through resistance right now, and then above the 200 there in purple. And then you could start talking about attacking that high I just anchored this line off of. And if you do that, then you really could be on to some catch up. And I have seen some speculative EOA in that space as well, just to kind of throw that out there. So yeah. So just be, just kind of keep that on the back burner, that if they really do ignite a squeeze in this market that maybe takes the S&P, I think it could certainly get up towards so if we say we're at 416, I think we're talking about another 4% to 6%. That's what I'm thinking. If they do exceed that 432 number that I am now calling kind of like my sleeper scenario that I've talked about on, well, weekend videos, also cocktail hour, that is where we would take out this high here. And I think that's the point, right, where a lot of people are going to look at charts and other factors and say, well, geez, I mean, this thing's taking out highs, had a good strong move off of those October lows. We often see lows put in October after bear markets end. It's probably double as potent as the next most potent month. And historically, in that case, we've been consolidating, holding gains, and now we're breaking out of the consolidation, the channel we've been in, and we're taking out more highs. I think a lot of people are going to say, I guess I've got this wrong based on the market action, but I think that might be the whole point of that market action. But that's really more of my own kind of economic take, instincts, and something I've observed many times over the course of my career than it is based upon hard data that I can produce for you. I certainly don't have that, unfortunately, because I'm really busy and just don't have the time to do that kind of thing. I wish I did. I wish we had people that could do that for us, or services that provide it, but we just don't. We do things in I guess you kind of call it a very frugal way, and we do the best we can with what we have. But that's not really the discussion in sector situation. The sector situation kind of conclusion would be that nothing looks wonderful. I don't think anything looks like surefire, this thing's going to go, or this thing's outperforming. The staples, again, defensive, they're ahead. Discretionary, a little more offensive, they're behind. But they went risk off to risk on. And I think they'll probably that probably will be maintained if they can keep the push going, which they have fuel to do it. They've got a lot of people underinvested. They've got a lot of people that just simply are pessimistic, do not believe that what this market's currently doing. They doubt what this market's doing. I mean, I'm in a lot of these camps. I just know better from my early days of getting on the wrong side and wondering just how irrational it can get, and then realizing that it can get so much more irrational than I ever could imagine, that you just can't do that for any real length of time. That's why like discipline position management is so important. I should say another reason why it's so important. But I don't think everything looks great. It is all within, let's say, earshot or shooting distance of a possible breakout, though. There wouldn't be, for most of these sectors are either very close or reasonably close to where if they do move things up with another melt up, then you really could get the follow through across the board. It probably will help to fix breadth a little bit. I mean, breadth is so bad. I showed that in macro measure. It'll probably start to help out in that regard, because people will think they don't want to miss the train's leaving the station, all that kind of thing. So I do think some of these sectors will stand out. Probably, right, the ones that they did not let drop very far, and the ones they typically love, like technology, communications, especially if they make new highs and break out, and you got 4-6% in the major indexes that they do pop the way we're thinking they could. Again, remember, I'm not projecting that. I'm not forecasting that. What I'm really doing is saying that's my most likely scenario. And I don't know if it happens this week or if it takes a while, or if I completely change my mind by the end of this week, if there's bad news and stocks really get clobbered. It all depends, right? That's what we do. I see it all the time. I see people arguing, online over it. And I can tell when someone's new and never managed any serious money when they get mad at someone out there putting together a forecast, and they get mad when that person changes their forecast from the prior week. And if they're mad, it's sort of like, well, wait a minute, conditions change. They didn't play out this time like I thought they would. What would you have me do? What would you have me still be a bear, even though it looks like they're going to take this market up and through resistance? Should I still be a bear just because I was a bear last week? That's the kind of fights you see going on out there in the Twitter sphere, as they call it. So it is what it is. But that to me is why I mentioned on Cocktail Hour that I think you just can't get locked in if you're a short-term trader. Even if you're a long-term trader, it's still probably off better. You're better hedging, I think, quickly, and then unhedging. And if you have to do that a couple of times and it costs you some commissions and maybe a little bit of money, hopefully at least you got on the right side in the end. It's staying on the wrong side stubbornly and fighting against things that can really get you in trouble or have you just miss out on great opportunities. So that's my little ramble for the week. I don't normally do that, but especially in sector situation, but I just try to help where I can. I don't get a lot of time with all of our customers. Ryan does, and Greg do most of the heavy lifting on that, because I'm really stuck in analysis world frankly, all the time. So I just spend my time doing a lot of analysis. So anyway, kind of a little different sector situation. I don't want to waste people's time in terms of the finer points here when I think it's risk on, risk off again. We have to see what happens with news. But I do like the idea that we're finally getting through most of the earnings where most companies will have reported. We've got the FOMC May meeting that will be in our rear view window when we record next week, when we're on Cocktail Hour on Friday. That's music to my ears, because I really hate earnings season and I hate being held up by the Fed. I like when stocks trade more on the technicals, because I have a much higher confidence and much fewer knuckle curveballs being thrown at me. And so that's what those couple of months, I kind of really like about 8 months out of the year a lot more than I like the other 4 earnings season months, whenever it falls that way. So I'm looking forward to that. And hopefully the movement that we saw pick up last week will resume and continue for some time, as it did in the first quarter, because again, I think the first quarter was a good quarter for trading if you're willing to be nimble and just take what's there and very, very little more. So thanks again for tuning in. I hope something I share with you helps you out this week or in the future. And everyone have a great conclusion to their weekend. Thank you.